I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Ted Dixon, CEO and co-founder of IncResearch.ca, Canada's first online financial news and research service. Welcome back to the show, Ted.
It's great to be back, Jim.
What's been the reaction of investors after 2 years of central bank interference in the equity markets?
Well, it's been a number of years, as you know, and I think we're getting to a tipping point. 2016 may well be the year that makes it or breaks it for the modern central bank. And I say that because of a couple of events that have happened already. In January, we saw the Bank of Japan try to basically depreciate the yen with its negative interest rates, and essentially what happened was just the opposite. The yen started to soar. It was the market basically, I think, sending a warning shot over the bow of the central bank battleships that all was not well with all the meddling that they've been doing in the markets, trying to essentially manipulate an outcome of higher inflation by messing around in the financial markets, by trying to drive yields and currencies lower. Then we had another minor skirmish, I think, during the Brexit vote when Mark Carney said, well, don't you dare vote to leave the European Union because it'll be a total disaster. Well, what did they do? They said, well, basically thumbed their noses at the central bank and voted for Brexit. And well, yes, the pound has gone down for sure, but the UK stock market has gone up. Other stock markets have gone up, and sort of the doomsday scenario of the British economy has yet to unfold. I mean, there's still plenty of time for policy mistakes to come along, but so far, the British Isles are still in the sea, and life is carrying on. So there was a democratic response to central banks, which is you probably any central banker worth their political salt, and they're all appointed politically, so they all have some degree of political blood in them, would take that development quite seriously. So now, on Friday of this week, we have Janet Yellen moving to speaking at the end of summer central bank camping festival in Wyoming called Jackson Hole, and this is an opportunity for her to lay a vision of where the Fed is going to go, and her back is against the wall, and I'll tell you why. Because basically, the Fed, for over 4 years, has missed its inflation target of 2%. Now, look, Jim, that is not my inflation target. That is their inflation target. I did not pick that. They picked that. So if the central bank has an inflation target and it's based off of what's called the Personal Consumption Expenditure Price Index, not the CPI in the U.S., then they have to convince investors and the public that they're going to reach it, or they should change it, okay? It's one or the other. Either you have this target and you're going to reach it, or you say, look, this target has to be rethought. We're going to go in a different direction. Here's what we're thinking. So she has to come clean. If she doesn't, we could be in store for a real, I think, a bout of chaos in the markets this summer. And that sounds a bit alarmist, but I'm not sure how much longer things can just keep kind of ticking along with investors, putting up with the kind of feuding we saw in the Fed minutes of July, where you've got a number of Fed officials wanting to hike rates, and then you've got the majority that say, no, let's just, give this some more time to see if we can hit our inflation targets. And in the process of this central bank experimentation, we've had the private sector, private enterprise, basically thrown into a state of upheaval because the risk-free rate that these investment bankers have been manipulating has gone to zero in the United States, essentially. Yes, they raised rates a little bit in December of last year. But in other markets, like major markets, it's now negative. And you cannot value a business properly without a risk-free rate that's above zero. Most of your listeners, I'm sure, are well familiar with sort of the basic premise of cash flow analysis, where you have to look at the future cash flows of the business, and you basically have to discount that by a competing interest rate to see, what makes more sense, buying a bond or, investing in a business that has cash flow. But to do that, you need a bond interest rate that's above zero. So we're in a state of upheaval, and we sent this out in a report to our clients on Monday, essentially looking at what insiders are doing, now after years of this monetary stimulus. Now we're at a state of private sector upheaval. What are insiders doing? And I can tell you, Jim, what they're doing. They're selling. They're doing what always works, and that is they're taking a profit. Now, we've seen this in the U.S. now for some time. Basically, the U.S. has underperformed Canada, believe it or not, so far in 2016. U.S. insiders have been taking money off the table now for some time. Well, now we're seeing it in Canada. We've had a nice move in the Canadian market year to date. The Canadian Insider Index, which people can track in real time on CanadianInsider.com. It's 50 stocks that are preferred by insiders that have good growth and value characteristics. It's up over 13% year to date, ahead of the TSX Composite, which isn't far behind. But now insiders in Canada are saying, thank you very much, double-digit returns. Yes, the move was driven by rebounding commodity prices, but we just don't know what's ahead with what Janet Yellen is going to say, if anything, on Friday. And the status quo is just not going to be an option because markets at some point are going to snap. Now, maybe they'll snap in a year, maybe they'll snap in 10 years. No one knows. But insiders are saying, thank you very much for our double-digit return. We're going to take some money off the table now, and maybe we'll get a better entry point. And you know what? Based on what you've seen in the U.S. in the past couple of years, there's been some big drawdowns in the equity market. If central banks continue the way they're going, you're probably going to have another opportunity to buy stocks at a cheaper price at some point, even if it's just for a day or two.
We'll have more with Ted Dixon right after the break.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome back. We're speaking with Ted Dixon. Ted, I remember a few months ago when I asked you what would be a good sector to get into, you mentioned something I haven't heard anybody else said, and you said packaging, because all these drones coming up and internet companies shipping stuff need to put it in something.
Well, that's right. And I think if you're looking to put money into the market, it really is at this point a stock picker's market. If you're a traditional investor, what I mean by that, if you're not a program trader, if you don't have a computer algorithm at home where you're, looking at minute by minute momentum, if you're not a technical trader that invests in charts, if you're a fundamentally driven investor, you really got to go and look at little bits of opportunity that exist in the market. So you have to look at themes that aren't overpriced and look at these areas that that insiders have good ownership in, have good buying, and look at those types of opportunities that may provide you with a longer term prospect of generating some value. Now, those opportunities are unfortunately hard to come by. They're just they're not available at really low types of prices. But Certainly the growth in e-commerce, the growth in pharmaceuticals is a trend that's here. If you can find stocks that are reasonably priced that piggyback off of that growth, then that's an area to look at. Another area that piggybacks off of that growth can be industrial REITs. Industrial REITs include those warehouses that internet distributors such as Amazon need to use to stage their deliveries. So there are a number of ways of looking at opportunities, but it's really a stock-by-stock approach. We have a great newsletter now that's available through CanadianInsider.com, through the Canadian Insider Club, and people can go to our website and check it out. But basically, it's our Insider Daily newsletter that was only available to our institutional subscribers, but we're now make it available by subscription through CanadianInsider.com. And every day, we look at different situations. And for example, in June, we wrote about an opportunity that we saw in the healthcare records management area, a company called QHR, and that was a company that has just received a take-out offer by Loblaws of all companies. So you've got a grocery store buying a company that's involved in records management. So you've got these types of sort of, I want to call them kind of one-off opportunities in certain areas of the economy that you maybe aren't obvious to the crowd because they're in very sort of distinct areas, but you really have to do your homework. So there are a number of good newsletters out there that you can look at. You can do some great screening, like discount brokerage houses such as TD Direct Investing have some great tools that you can use to look at the valuation and drill down from there. But if you're a fundamental investor, it's really hard to find these opportunities these days. And the reason is you've got central banks inflating stock prices, and you've got algorithmic traders piggybacking on that, driving up prices. I mean, look, Jim, this year so far, what have we seen? We've seen Vancouver home prices go up 30%. In the same year, we've seen oil go from a bull market to a bear market, back to a bull market, all within a matter of weeks. I mean, this is the type of environment we're trying to invest in. And so until central banks change their game and basically take a step back and let markets clear, you're right. You're going to have to look at these little areas in the market that haven't been broadly covered by large investment funds, large quantitative funds. If you're a fundamental investor and you're patient and you do your homework, then there are still opportunities out there. So, but it really involves doing your homework to find them.
Are we reaching the stage where it's more important to keep your money than invest it in something that's going up?
Well, I mean, everybody has different requirements and different different needs. So if you're well nested and you've got a nice nest egg and you're around retirement age, well, why take risk at this point? But not everyone is in that position, and they still need growth of capital. And the central banks have been doing a huge disservice to those people by forcing them into a lot of investments that they've done well in many cases, in terms of yield investing, but there's no guarantee that cannot change on a dime, at any minute. And people like me have been talking about this for a long time, so it's easy to kind of discount it and say, well, let me know when it happens. But unfortunately, nobody rings a bell at the top, and all of a sudden things can unravel quite quickly. So whatever the approach is, if you are investing, a diversified approach is key. It's important to have at least some gold to hedge. But, you wouldn't want to be overly invested in gold, because you just don't know if the central banks are going to throw in the towel and say, okay, we're going to let markets clear. At that point, you would have a nice, I call it a nice correction, a nice clearing correction where prices would find their true value, and then you would have lots of opportunity in the market. So you don't know what gold would do under that situation. If the central banks really did step back, it would probably have a last spurt of buying, but as new investment opportunities emerge, people would probably sell their gold to buy the investment opportunities. So diversification is really important, and having some insurance, whether you use it through derivatives or through gold or having some cash on the sidelines, is really important, particularly as we're heading into the fall here, because things have been going pretty smoothly in August. Look, don't be lulled in by that. Things were going very smooth in August 1987, before the crash of October 1987. The market was still going up, even though you had lots of tension in the currency markets. So, anything can happen here. It's important for investors not to get complacent.
Well, Wednesday will mark the anniversary of Black Friday. Any chance of that happening here in August again?
Something could happen at any time. You just don't know. There's so many program trades now that are based off of headlines that you don't know what headline could tip these traders into all going for the exits at the same time. You just don't know. So it could, we may go another 10 years in this sort of state of suspended animation, but it may be a matter of days or minutes. You just don't know. And until you let markets get back to their own natural rhythm, you're not going to have that kind of certainty. So certainly with, government bond yields, in many cases in the world offering negative yields, it's a very risky environment. Interestingly, Japan may have seen the bottom in government bond yields. And if that's the case, then we could really be in store for something. At this point, though, the Western Europe and North America bond yields haven't shown any signs of breaking to the upside. So, it's something to watch. We're certainly not at the point where I think you would declare the bull market in bonds, dead by any stretch of the imagination. But there are some indications in Japan, anyways, that maybe we're going to see a turn, or we have seen a turn there, and that would foreshadow an eventual turn here in North America and in Europe.
Japan's largest bank doesn't sell government bonds anymore because those bonds are negative.
Well, and you've got a case in England where you've got the Bank of England trying to distort the market, trying to gobble up all the gilts. But, there's a lot of insurance companies and pension funds don't want to sell their gilts because they need them to run their business. So, you have this tug of war now going on, and that's a total market distortion in terms of what's going on with the gilt yields. And, so it looks good on paper for these institutional holders who keep seeing the value of their bonds going up, but they can't sell them because they need them to run their business. They need to have a certain amount of fixed income that has a relatively low risk profile on their books. So, it's really, we're at a point of central bank madness. It's not, there's no other way to really describe it. And, Janet Yellen really has to shine on Friday, or we're all going to be left scratching our heads as to what the implications are for investing in capital markets if we just keep on the path that we're on.
Well,
right
it looks
now.
like we're on a closed feedback loop. Janet Yellen saying, I'm listening to what everybody else is saying to make my statement, and everybody else is saying we're waiting for Yellen to make her statement so we know where we stand. It's very confusing.
Well, that's right. And then you have to wonder, who's influencing who? Is the market influencing the central bank, or is the central bank influencing the market? And so, we've got this Hawthorne effect type of environment, but it's hard to really determine, who's subject to it. It seems like both groups are, and like you said, we've got this loop that's going to go round and round, and that's why. But we don't know when this spinning is going to stop. It's like I just bought a spinning toy for my son, and you can spin it on the floor, and if you get a good spin, it can keep going on and on and on and on. But sometimes you miss, and it kind of spins out of control pretty quickly. So we'll see how long Janet Yellen's prepared to spin this loop around and around. And we'll see how stable markets can be. But I have a sense that she's going to use Friday as a way to stop the spinning and reset expectations for monetary policy going forward. If she doesn't, it'll be one heck of an interesting September.
Ted, thank you so much for chatting with us.
It's great to be here.
My guest has been Ted Dixon, CEO and co-founder of InkResearch.ca, Canada's first online financial news and research service. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our popular YouTube channel is Talk Digital Network. Questions can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.